In a nationally televised address on April 19, 2026, Canadian Prime Minister Mark Carney told his country that the relationship Canada had built with the United States over 80 years, the pipelines, the supply chains, the integrated factories, the shared energy grid, had stopped being a source of strength. His exact words were, "Many of our former strengths, based on our close ties to America, have become weaknesses that we must correct." He described the tariffs the United States had imposed on Canadian goods as reaching levels last seen during the Great Depression. Within hours, President Trump responded with 4 words, "Canada lives because of us." The comparison to the Depression era is grounded in the historical record. Analysis published by the Peterson Institute for International Economics shows that the current effective tariff rate on Canadian goods entering the United States represents the most significant trade barrier imposed by Canada by Washington since the 1930s. Carney's argument was not that Canada made policy errors. His argument was that deep integration with the U.S. economy, the very thing that drove Canadian prosperity for decades, had created pressure points that a determined trading partner could exploit. The question his address raised was whether that diagnosis is accurate and what the data shows about the state of the relationship. The structural basis for his concern is a single number. In 2024, 76% of all Canadian goods exports went to the United States. When one country absorbs that share of another's exports and then imposes tariffs, the economic exposure is immediate and difficult to route around. The infrastructure and supply chains built over decades to serve that relationship do not redirect quickly. The auto sector reflects the scale of the problem. Canadian auto production fell 5.4% in 2025 and was projected to continue declining in 2026. Manufacturing in Ontario is organized around just-in-time supply chains that cross the Canada-US border multiple times before a finished vehicle exists. 25% tariffs on both vehicles and components change the cost structure of those chains in ways that affect employment decisions over time. Quebec's premier estimated publicly that sustained tariffs could cost that province alone as many as 100,000 jobs. At the same time, the data shows the correction Carney described was already registering in trade statistics before he addressed the country. In the 12 months to January 2026, Canadian merchandise exports to non-U.S. markets rose 17% year-over-year, while exports to the United States fell 10%. The U.S. share of Canadian goods exports dropped to 71.7% in 2025, the lowest level since the early 1980s before Canada had a free trade agreement with the United States. Canadian companies recovered $11 billion of the $18.5 billion in business lost to U.S. market disruption by expanding into 27 other trading partners. The dependency, however, is not one-directional. The United States imports an average of 3.9 million barrels of Canadian crude oil per day, more than from all other nations combined. More than 70% of American Midwest refinery capacity is built to process Canadian heavy crude, and those refineries cannot switch to alternative supply without capital investment measured in billions of dollars and timelines measured in years. The U.S. Energy Information Administration has confirmed this directly. 99% of U.S. natural gas imports come from Canada, nearly all by pipeline. In 2023, Canada exported approximately $2.9 billion in electricity to the United States, against $1.1 billion flowing in the other direction. Both statements made on April 19th and 20th, Carney's assertion that the relationship has become a weakness and Trump's assertion that Canada depends on the United States, are simultaneously accurate about different dimensions of the same relationship. Carney is describing the trade volume exposure Canada faces when tariffs are imposed. Trump is describing the market access Canada requires to sustain its export economy. Neither reading is wrong, and that is precisely what makes the current negotiating environment difficult.
The tariff timeline shows how the pressure accumulated. The Trump administration announced 25% tariffs on most Canadian goods and 10% on Canadian energy in January 2025. Canada responded with retaliatory tariffs on $30 billion worth of U.S. goods, which escalated to more than $90 billion over the following weeks. The tariffs were briefly paused, then reimposed. By August 2025, the rate on non-USMCA Canadian goods had risen to 35%. In February 2026, the U.S. Supreme Court struck down the legal authority the administration had used to impose those tariffs. But within days, a replacement 10% global tariff took effect under a different legal framework, while sector-specific tariffs on steel, aluminum, and automobiles remained intact. Those sector tariffs, steel at 50%, aluminum at 50%, autos at 25%, are the ones Carney described as reaching Depression-era levels. They were not affected by the Supreme Court ruling. General Motors disclosed in its 2026 financial guidance that it expected $3 to $4 billion in tariff costs that year. Industry analysis found the tariffs could add $1,500 to a U.S. manufactured vehicle. Canadian households were estimated to be absorbing between $1,700 and $2,000 per year in additional costs. The economic damage is distributed across both countries, not confined to one side.
Canada's policy response extended beyond retaliatory tariffs. Carney traveled to Beijing in January 2026 and secured a trade arrangement allowing 49,000 Chinese electric vehicles into Canada annually at a reduced tariff of 6.1%, down from 100%, in exchange for China reducing tariffs on Canadian canola, seafood, and other agricultural products. Canada's finance minister traveled to Beijing in early April 2026, accompanied by the Bank of Canada governor and delegations from major Canadian financial institutions. The United States responded to the China arrangement by threatening a 100% tariff on all Canadian goods if Canada proceeded with deeper trade ties with Beijing. Canada continued on its course. The Trans Mountain Pipeline, with a capacity of 890,000 barrels per day, was running near full capacity in April 2026, with China as the leading buyer on that corridor. The LNG Canada Phase 2 expansion in British Columbia was designated a project of national significance by Carney, placing it on a fast-tracked federal review. Alberta is planning an additional pipeline to the northern British Columbia coast with a capacity of 1 million barrels per day, with a federal application expected by July 2026. These are the operational expressions of what Carney described as correcting the weakness, not ending the relationship with the United States, but building the infrastructure and trade relationships that reduce the proportion of Canada's economic output dependent on U.S. market access. At the center of this realignment sits the Canada-United States-Mexico Agreement Review, with a mandatory decision point of July 1, 2026. Under the agreement's terms, the three governments must decide by that date whether to extend the deal for 16 more years, begin annual reviews, or signal withdrawal. U.S. Trade Representative Jameson Greer confirmed on April 7 that he did not expect all issues to be resolved by the deadline, and indicated the U.S. intended to pursue separate arrangements with Canada and Mexico rather than renewing the existing trilateral structure. If the agreement enters a cycle of annual reviews rather than being renewed, the uncertainty around cross-border trade terms does not conclude. It becomes an ongoing condition affecting investment and production decisions on both sides. The costs of the current environment are already measurable in household terms. Retail gasoline in Canada averaged $1.89 per liter in early April 2026, up 30% from the prior month. The EIA projected U.S. retail gasoline peaking near $4.30 per gallon that same month. Diesel was forecast above $5.80 per gallon in the United States. Those fuel price levels were driven primarily by Middle East supply disruptions, not by the Canada-U.S. trade dispute directly. But the tariff environment on steel and aluminum compounds the broader cost pressure. The U.S. fertilizer supply had dropped to approximately 75% of normal levels by mid-March 2026, affecting the planting window for Corn Belt farmers. The structural tension Carney named on April 19th runs through the full picture. The very integration that generated decades of mutual prosperity, the shared pipelines, the auto supply chains, the electricity grid, is also what prevents either country from walking away cleanly. Canada cannot redirect its eastern manufacturing base overnight, given that parts of Ontario depend on pipeline routes that cross U.S. territory. The United States cannot replace Canadian crude at scale without rebuilding refinery infrastructure that does not currently exist. Both governments are constrained by infrastructure decisions made over the preceding decades, and both are now navigating those constraints under conditions of political tension and economic pressure. Canada's stated direction is to reduce the dependency over time. The Trans Mountain Pipeline at capacity, the LNG expansion, the finance minister in Beijing, and the 17% growth in non-U.S. exports are the measurable steps in that direction as of April 2026. As of Carney's address, the sector tariffs remain in place. The USMCA review deadline is weeks away, and the U.S. Trade Representative has confirmed a complete resolution is not expected by that date. The U.S. share of Canadian exports is at its lowest in 4 decades. Non-U.S. trade is growing, and $2.5 billion in goods and services continues to cross the Canada-U.S. border every day, under terms that are actively being contested. The households on both sides absorbing the accumulated costs of this standoff through fuel prices, manufacturing employment, food costs, and investment uncertainty are not waiting for the diplomatic question to be settled. They are already living with its economic output.